In this video, we'll be completing the sample daycare problem that we started earlier. In this problem, we're demonstrating the accounting cycle. You'll want to have in front of you the sample daycare problem, the original one that you used before, that has the trial balance and then the transactions on the bottom of it. And you'll also want to have in front of you your printout of the worksheet that we were using to record the transactions in the equation style. Let's quickly review where we're at in the accounting cycle. So this is actually from a set of notes that you had provided to you earlier. They were titled The Accounting Cycle Part 1, and it does just that. It shows you the steps in the accounting cycle. What we've done for sample daycare so far are these first 3 steps. Throughout the year, it was year 3 in our sample daycare problem, we considered each of 10 economic events that happened. And of course, we had to ask ourselves, does the event have accounting significance? Was there more than an exchange of a promise for a promise? In our 10 very simple transactions for sample daycare, they all had economics and accounting significance, both. So since they all had accounting significance, we classified them, measured them in US dollars, and recorded the transactions. Instead of recording the transactions in a general journal as a journal entry and then posting that journal entry to a general ledger or showing it as being posted to a T account, we simply recorded the transaction in what I will refer to as accounting equation format, in a worksheet that shows that each and every transaction balances across the equal sign, and the entire accounting system is still in balance when we're done. The last thing we did for the sample daycare problem is calculate unadjusted balances in each one of our accounts. These are the transactions that you should have recorded with me in the prior video. And this line right here, these are our unadjusted balances. So these are our starting points for the work we'll be doing next, the next step in the accounting cycle. One thing to remember, though, is that we're recording all of our revenue, expense, and our dividends transactions directly into the retained earnings account. So we don't have separate accounts set up for things like daycare revenue, wage expense, dividends, and daycare supplies expense. All of those have been recorded instead directly in the retained earnings account. Revenues are a positive number because they increase retained earnings. Expenses and dividends decrease retained earnings, so they're negative amounts here. This is the step in the accounting process where the accountant really puts on their detective hat and says, let's look at each and every balance in our general ledger system and ask, is it correct? Thinking about our standard way of handling the way we record our day-to-day transactions throughout the accounting period, is there any reason to expect that some of these accounts need to be corrected? And we know from the work that we did in the sample daycare example that that is indeed the case. For example, we know when sample daycare paid this $3,600 for a 6-month lease that we put the whole amount here in the asset account, prepaid rent, even though we knew that the rental period started in November of year 3, so a couple of months of this $3,600 would be used up and should actually be an expense when we go to do our financial statements. So there's lots of accounts that need to be corrected or fixed because of the way a company might choose to handle day-to-day transactions in an attempt to standardize day-to-day recording. In addition, there's some changes to accounts that might need to be recorded just because time has passed. We'll see here that some interest expense should be recorded, and in addition, because time has passed, some of the utility of this furniture would have been used up as well. So those are the types of reasons that require almost every company to do a series of adjusting entries before they can prepare financial statements. All right, well, in our case, If you go back to the initial problem, again, this was the handout where you had the trial balance to get our beginning balances in accounts. We recorded entries 1 through 10 previously, and now we're at this point. We're going to utilize this information in A through E and try to record all of the appropriate adjusting entries for sample daycare. Let's start with the first bit of extra supplied information, the information for A. It says at 12/31, year 3, there's $400 of office supplies on hand. What that means is somebody went to the supply closet, and this is something every company would have to do at the end of every accounting period. They need to go out and inventory or count things like supplies. So someone went to the supply closet, they opened up the doors, they counted all the office supplies in there, figured out the cost of them, and came up with $400. That $400, of course, represents the amount of supplies that have not been used yet, that are there to benefit the future, year 4 at very least, for sample daycare. The question we want to ask ourselves, of course, is, well, what's the balance in the general ledger account right now? If you go back and take a look at the work we've done so far, you'll see that the unadjusted balance in the office supplies account is $3,700. Not $400, but $3,700. How are we so wrong? Well, it's because we used a rule of thumb. The rule of thumb for office supplies was every time we purchase them, we're going to stick them in the asset account. So we started the year off with $1,700 of office supplies. We purchased another $2,000 worth of office supplies. So there's actually $3,700 in that account, and that would be a fairly common rule of thumb. Some companies always put every single purchase of office supplies into the asset account, and they know at the end of the year they'll inventory, they'll count what they actually have, and they'll do an adjusting entry to correct this account and reflect the amount of office supplies that were actually used during the year. Let's do that. Well, ask yourself, what does this $400 represent? This $400 represents the correct ending balance in the office supplies account, right? So we know we have a beginning balance in this account of $3,700. That's our unadjusted balance. And I'm just working here sort of off to the side. You can actually, well, I'm working off to the side so you can see that we're going to record a balanced adjusting entry. Look at the adjusted balance. We'll then go back. You can go back and actually record the adjusting entry, which is what we're trying to come up with here, in the spreadsheet, just like you would record any other transaction. Adjusting entries are specialized transactions, but they still fit the general rule. Whatever you do in the accounting equation, it has to balance across the equal sign. There are a few additional rules, or at least a couple of additional rules for adjusting entries. Think about what we're doing. We're the accountant. It's after the end of the year, and we're looking back at our accounts and correcting balances. So there's no external exchanges going on. Cash should not ever be a part of an adjusting entry unless you needed to do an adjusting entry to reconcile your bank account. So for us, cash will never be involved in an adjusting entry, because this is just an after-the-fact correction that the accountant is posting. You post your adjusting entries as of the last day of the accounting period. Cash should not be affected. What will be in every single adjusting entry is a change to a balance sheet account and a change to an income statement account. So if you can get it narrowed down, you know what one of those accounts is, you can usually back into what you think the other side needs to be as well. Well, what do we know here? Here we know that the adjusted balance, the correct balance, the balance that we want to have on our balance sheet for office supplies under assets, is $400. That tells us that our adjusting entry needs to be a decrease to the office supplies account of $3,300. What's the other side of that entry? Well, why are we making this correction? Because throughout the accounting period, we used up office supplies. We just have never recorded the fact that we used them up. Every time we purchased office supplies, we put the cost into this account. But when people went and took a ream of paper or a new stapler or whatever out of the closet, that never got recorded. So what hasn't been recorded here is the use of office supplies or office supplies expense. So reduce assets by $3,300. Specifically, we're reducing the office supplies asset account and record instead office supplies expense. We would say that the balance in the office supplies expense account is $3,300. You wouldn't say it's a negative balance. It's just that office supplies expense is a contra equity account. It's an expense. So in the equation, you list this as a negative amount because expenses reduce retained earnings. But if somebody said, what's the balance in the office supplies expense account? You would just say $3,300 because a normal balance for office supplies expense is negative equity, or a debit balance, if you recall our debit credit work in the prep course. So notice that the adjusting entry balances here. Reduce assets, reduce equity by $3,300. We don't know. We don't have a beginning balance here in retained earnings, so we're not trying to show, we don't have an entire accounting system here. All we're focused on is enough information to get us the correct adjusting entry. Here's a useful way to think about supplies. If a company has supplies on hand at the beginning of the year, we'll call that the beginning balance in supplies. If you take their beginning balance in supplies, so these are supplies sitting on the shelf on January 1st, year 3 for Sample Daycare, and you add the cost of all the supplies purchased throughout the year, here $2,000, then the total of those two things would be all of the cost of all of the supplies available to use during the year. It's doubtful you had $3,700 of supplies on the shelf at any given time. That's just throughout the year the maximum amount of supplies that could have been used. It's the beginning balance plus the purchases. Once you compute the cost of all the supplies available for use, if you know what you had left in inventory, what's in the supply closet in effect at the end of the year, the difference will be supplies expense, the cost of the supplies that actually got used. Or, in this problem, instead of telling you that there was $400 of supplies left on the shelf at the end of the year, I could have told you that Sample Daycare computed that they had used $3,300 worth of supplies during the year. You would have subtracted $3,300 as the expense and come up with $400 as what must be the ending balance in the supplies account. This would be the more normal way to think about it, though, because for most companies it's easier to go count the supplies left in the closet than to try to keep track of the supplies used. So you'll want to go to your worksheet and do the same thing here. Record the reduction in the office supplies account, and then over under retained earnings record our office supplies expense. And the other thing you would always do is compute the adjusted balance in the balance sheet accounts and ask yourself, is that right? Did my adjusting entry accomplish what I wanted it to do? And here we feel good about it because after our balanced adjusting entry, we have what we wanted, a $400 balance in the office supplies account, which matches reality. Okay, well, let's do the same thing for adjusting entry B. Adjusting entry B is a little bit different because we used a different rule of thumb than we normally would. Adjusting entry B has similar information to what you saw in A. It tells us what the balance in daycare supplies. It tells us what was in the daycare supply closet in effect at the end of the year. So there's $100 of daycare supplies, again, pudding, Pampers, whatever it happens to be, sitting on the shelf in the closet. we want to look and see, okay, what's our unadjusted balance in the daycare supplies account, and what's the adjusting entry that we need? We'll take a look at what we have recorded so far with respect to daycare supplies. And if you look back, you'll see when we recorded our transactions, I told you to, instead of putting the cost of supplies purchased in the supplies asset account, to instead record the full amount immediately as daycare supplies expense. So we recorded the full amount here as daycare supplies expense. Other than that, the same logic really applies though. You start by saying, well, what should be? What's the correct balance? What do we want to have in the daycare supplies account when we're all done? Well, what we want to have in daycare supplies is what? $100. So you know what you need to do, and the adjusting entry has to balance. In this case, you know you have to increase daycare supplies by $100 in order to get the correct ending adjusted balance in that account. The only thing that's going to balance that entry is a positive under retained earnings of $100. That should also go to the daycare supplies expense account, because this is an adjustment to the expense account. If you think about it this way, they purchased $8,500 of supplies during the year. There's $100 left, so they must have used the other $8,400. So the daycare supplies expense account is too large. This $100 reduces the expense account. So this is our balanced adjusting entry: increase assets, increase retained earnings by decreasing an expense account. And you can actually see here that this is where, in this type of situation, this is where the debit and credit terminology can actually be a little less confusing than talking about increasing retained earnings by decreasing an expense account that's a negative retained earnings account. But when you look at it in the equation, you can see what we're doing actually still makes sense. If we had a separate account for daycare supplies, instead of recording these things directly in retained earnings, you'd see that right now the adjusted balance in the daycare supplies account would be $8,400. If we listed it under here, of course, it would be negative $8,400, just to show that it's a reduction to equity. But that balance makes sense. If we didn't have, well, let's do that reconciliation that we did for office supplies expense. Our beginning balance in supplies, in this case at the beginning of the year, was $0. They purchased $8,500 worth of daycare supplies. If there's still $100 of daycare supplies left, they must have used the other $8,400. So what I'd like you to realize is, if you contrast the way we recorded daycare supplies originally, and you contrast that to the way we recorded our purchase of office supplies, you'll see we used very different rules of thumb. But it really didn't matter. No matter how we record that original entry, we can find one balanced adjusting entry to correct both the supplies asset account and the supplies expense account at the same time. And the same would hold true for any other type of situation where we applied a rule of thumb. For us, unless a problem specifically says, this is how an entry was recorded, you would assume that everything in the past was recorded following our normal rules of thumb. And our normal rule of thumb for supplies, remember, is we would record the purchase as an asset as opposed to an expense. So the way we will normally do things is like the office supplies approach as opposed to the daycare supplies approach. But I did want you to see that we could handle it either way.